Here's the 30-second lesson on what legends know. Never practice nunchucks in a crowded room. Never eat chole before a road trip. Always take your shirt off before you iron it. Don't take a call near a swimming pool. And don't forget, saving is not investing. Legends don't just save, they invest in mutual funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint. And this time we're going to be talking about all of this roiling, this volatility that we've been seeing in the stock markets. We had something that now is being called Black Monday, which is the last Monday where markets across the world crashed. Now, what does this volatility mean for markets in India? That's what we're going to be talking about. Why also it happened, that's also what we're going to get into. To discuss all of this, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, first let's go into what happened on this so-called Black Monday. Which markets fell and how was India affected?
So across the world, we saw markets fell on Monday. There was a confluence of a number of global developments that we can talk in detail. Right. But across the globe, we saw markets falling. And in fact, India markets fell relatively lesser as compared to in other economies. For example, other advanced economies, we saw much steeper fall in markets because of a confluence of unfavorable external events, not domestic, but mostly right. External events, one being the US coming up with a slew of weak macroeconomic data, particularly right. with regards to the labor market, because labor market is one thing which is keenly watched by the US Federal Reserve when they make decisions about interest rates, in addition to looking at the inflation number. So there was a consistent weakness seen in the US labor market that triggered fears of recession. So right. that was one, and we can talk about more in detail. The other was Japanese central bank announcing a rate hike. Now, we've talked about this earlier in March. Japan Central Bank reversed its negative interest rate regime because earlier they were following a negative interest rate regime to stimulate its economy post the global financial crisis, and they announced a positive interest rate in March, and they carried that forward on 31st of July. They announced another round of rate hike, and that destabilize the markets. And what is the transmission channel we can talk about. And third is the geopolitical tensions, the escalation of the geopolitical tension at the Middle East, which is leading to volatility in commodity prices, right. Particularly global oil prices, and that has a major bearing on Indian stock markets. So primarily these were these three factors that impacted markets across the world and also in India.
Okay, so let's go over these factors one by one. Let's start with the US.
Right.
So what was the data that they brought out that spooked global markets so
Correct.
much?
So till now, what we have seen is, we've done some discussion on the US economy that despite the fact that the US Federal Reserve had has been raising interest rate, and they have raised now by more than 500 basis points, particularly 5.25% to be precise, since 2022. But despite that, we've been seeing that the labor markets have remained quite robust. We haven't seen a decline or weakness in labor market as reflected in the unemployment rate, or what we, another measure which is closely gauged is the non-farm payroll employment. But over the last 2-3 months, there has been weakness in the labor market, and towards July end, we saw that the labor market data, which is primarily the unemployment rate and the non-farm payroll employment rate, non-farm payroll employment showed weakness. So the unemployment rate inched up to 4.3%. Which is the highest in the last 3 years. Right. So that is one point. The other is that the non-farm payroll employment, the increase that happened in July was the slowest as compared to the last 12 months. So the average increase that has been happening is over the last 12 months is somewhere around 215,000 every month. But in July, the increase was only 114,000. So that is again, talking about weakness in the labor market. And because of the steep rise in unemployment rate, a very closely watched indicator in the US, which is telling us some early signals about recession, it is called the Sahm Rule of indicator of recession.
Right.
That indicated the onset of recession in the US economy.
It's pegged to the employment rate?
It's pegged to the unemployment rate. So it says that if your the current 3-month average of unemployment rate is half a percentage point higher than the lowest unemployment rate over the last 1 year, that means that using this metric, it shows that the economy is already in recession. So if your 3-month average unemployment rate is half a percentage point more than the lowest unemployment rate that you would have seen in the last 12 months, it shows recession. And it has it has captured the state of recession quite effectively and accurately over the last couple of years. Global financial crisis, it captured recession. COVID, it captured recession. So during all these phases, we see this indicator shoots up. So this is basically the difference between your 3-month average of the current 3-month average of unemployment rate and the lowest unemployment rate. And so if this difference is more than 0.5%, that means that it is recession according to this measure.
Yeah,
now,
because something like this would maybe apply only to developed economies where the workforce is entirely formal.
Right.
Where we have an informal workforce like us,
Yeah.
things like unemployment cannot be a basis for judging whether we're in recession
Absolutely. And even in the US, even the economist that has founded this indicator, she herself is saying that this time around it may not be the case. And we have to, though it is signaling slowdown, it is not a recession going by the textbook definition, because you need to look at other variables as well. You need to look at what's happening to consumer spending and so on. But definitely it is signaling a slowdown and something needs to be done about it.
Right.
So that is one factor that spooked markets, that US is because they started looking at the recession indicator, the Sahm recession indicator, and it showed a sudden spike to more than 0.5%, which is the threshold for the onset of recession. So that resulted in the sentiments getting affected in markets and triggering a sell off. So FIIs were the major sellers, and that resulted in a decline in market.
And of course, I mean, the US being the economy that it is, as dominant as it is, and its markets also being so deep, anything that happens there has knock-on effects on world markets. So that's one of the reasons. The other factor that you mentioned was what happened in Japan.
Right.
Now, we have done an episode before about the interest rates and what the Japanese central bank has been doing. What did it do most recently that triggered this?
Yeah, so on 31st of July, it increased the interest rate. The Bank of Japan announced a 25 basis points rise in interest rate.
Right.
What it did in March was the reversal of the negative interest rate regime. And at that time, the short-term interest rate was announced in the range of 0 to 0.1%. So we were moving to a positive interest rate regime. And now the interest rate has moved to 0.25%.
Right.
Now, because interest rate rose, the entire strategy of carry trade in yen got disrupted or upended. Why? Because carry trade is a very important strategy. It's a very dominant strategy that investors follow, global investors across the world follow, where they borrow in a currency which has lower interest rate, and then after borrowing that, they convert it into say dollars and then in rupees, and then they invest in assets which are offering higher rate.
So they make a profit.
They
on
make
the
a
difference.
Profit even after accounting for hedging cost and exchange rate. If the interest rate that Japan was, it's a zero interest rate regime, and here say you're getting 6 to 7% interest rate, then you are making profit. So carry trade with yen was a very profitable strategy till the point in time that Japan was following a zero interest rate regime. And because Bank of Japan announced an increase in interest rate, this entire carry trade in yen funded carry trade suddenly became unprofitable, and the investors who had taken short position, or they had to lend back, they had to repay back yen. Suddenly it became costly for them to repay back because the interest rate has risen. So they are now re-evaluating their risk return strategies at a point where on the one side Bank of Japan is looking at raising interest rates, and on the other side the US Fed is now talking about cutting interest rates. Because of the weaker labor market, there is a pressure to even announce an off-cycle interest rate cut and not wait till September, or even if wait till September, if earlier expectation was for a 25 basis point cut, now it is a 50 basis points cut. So now the entire risk return strategies have got a bit disturbed, and investors are re-evaluating and they are unwinding their yen funded carry trade strategies, and that is causing destabilization in the market, is causing turbulence in the market, it is causing uncertainty in the market, and even in India that is one of the factors that impacted markets.
Right, and the Bank of Japan governor did subsequently say that he is not going to raise rates further during times of market volatility. But the thing is that the two are related. If he raise rates, there will be volatility. If there is volatility, he won't raise rates. So that itself is causing quite a lot of uncertainty as well. So markets are expected to remain volatile for a little bit.
Yeah, and also the yen dollar rate has suddenly changed. It was yen was earlier depreciating, and now because the yen denominated assets are offering a higher interest rate, yen is appreciating against the dollar, and that is causing more capital inflows into Japan, and that is making yen more expensive, therefore leading to this entire carry trade in Japanese yen has become unprofitable or costly. So the investors are unwinding their position by selling, liquidating their investments, and that is causing the crash in the markets.
Right. And the third factor is perhaps the most self-explanatory, which is what's happening in the Middle East. But what kind of impact is that having on commodity prices right now?
Right. So it's causing volatility in commodity prices, and that is which will have an impact on inflation, and that will have an impact on interest rate decisions by the RBI. Because there was this expectation today. The monetary policy announced its interest rate decision. There was this expectation among some quarters of investors and experts that, in fact, at least the stance would be changed from withdrawal of accommodation to neutral. So because across the world there is a tendency towards, there is a shift towards easing of monetary policy. Bank of England has already announced a 25 basis points cut in interest rate. US is going to do it. So India should also do it, but that did not happen. So because of the volatility in oil prices, and that's one of the factor that is mentioned in the monetary policy statement as well, that if oil prices rise, that will have an impact on wholesale price index, and that will have an impact on consumer price index, and also the core prices, core inflation, which was till now showing a downward trend, it may have bottomed out because we are now seeing upward pressure on core inflation as well. So there is a possibility of transmission happening from input prices to output prices. Even if we look at the commentary from the PMIs, the PMI manufacturing and the PMI services, one of the critical component of that is the input cost pressure. And the entities who are surveyed, they are telling us that the cost pressures are rising, and slowly they will be passing on to in the form of increase in selling prices. So all that is because there is uncertainty on the global front, which is causing volatility in global commodity prices.
So overall, you feel that the RBI did make the right decision right now by keeping rates unchanged? Because I know that there are some people, in fact, two members of the Monetary Policy Committee,
dissented,
again, twice now they've dissented saying that they should cut rates. But overall, you feel that
Yes, I feel because there's still inflation remains elevated, and there was a declining trend, but in June we saw inflation again rose. Food inflation remains elevated, and RBI governor also kind of gave a rebuttal to the recommendation that was put forth in the economic survey that perhaps we should look at inflation stripped of food prices.
Right.
So that is not a prudent strategy in a country like India, where inflation is understood to be food inflation. Households will not understand if we exclude food, then our household inflation expectations would not be aligned with what the RBI is targeting. So all those problems are there, and those the RBI's thinking on that was clearly articulated by the governor in the policy meeting. So I think it's better to wait and watch to get more clarity on how the global events are unfolding and how what's happening to monsoon, whether the spatial distribution becomes more even, and do we see a decline in food prices, because we will see a decline in food prices because of the base effect, but momentum wise it hasn't declined. So I think on all counts it was a sensible decision to keep the rate and the stance unchanged.
okay, and now coming again to India, all of these factors that are happening abroad in the stock markets, in various exchanges around the world, it's of course impacting us. But as you said in the beginning, that even on this Black Monday, the markets in India didn't fall as much, and now they've bounced back,
Right.
and in response to the RBI governor's statements, they again fell.
Right.
So there is still a lot of volatility here, right?
Yes, there is. So that is going to be the case, that while we won't see the kind of significant slide or turmoil or bloodbath that we are seeing in other markets that are more export oriented, that are more sensitive to whatever is happening in other markets, but there would be some impact on Indian markets, though relatively less, because our own macro fundamentals are relatively sound. There
Right.
are these concerns with consumption, and there are these concerns about food inflation, but relatively we are much better off, and therefore whatever the fall or the rise is happening, it's not to that significant extent, but in the near term volatility cannot be ruled out, and because of a number of domestic as well as external factors, we will see in the near term volatility will be there.
Right. And here there are two things that I would like to mention. One is that our domestic investors are very, very resilient. They just keep pumping in money into the markets. I mean, sometimes it concerns the government and the stock market regulators, but these people, mostly households, the retail investors, they're very confident in the markets. They believe that the markets will continue to go up, and they keep putting money in. And so that's why that stems the fall when a fall happens. But on the other side, there is also concern that the markets are very overvalued. And the thing is, a lot of analysts that I've spoken to, they've been warning that, especially in times of overvaluation, if something unexpected happens, then a fall in the market can be far sharper. And in India's case, a lot of retail investors can lose money. So, there is a need to be a little prudent when it comes to investing. Look at the fundamentals of the companies that you are investing in. Don't just go by narratives. But overall, these are the factors that are driving India's market. Now, we have a question from the audience, which is by Saurabh. He asks, with fears of a recession in the US triggering this sell-off, it will put major pressure on the rupee exchange rate as FIIs pull their money out of India. Considering this, how likely is the RBI to repeat the giant dividend that it gave the government last year? How likely is it to repeat that again?
Yes, so it's true that FPIs are the major sellers, and as you rightly pointed out, domestic investors are not taking out money. It's the FIIs that are taking out money, and that is causing the markets slide. But on the point of RBI dividend, first we need to understand what caused the hefty dividend in FY24.
Right.
And if we look at the causes, there were two causes. On the expenditure side, the provisioning were lower, so that led to higher income for the RBI because the expenditure was lower. On the income side, RBI earned on its foreign investments because the US T-bills were offering a higher interest rate. And we know that if you look at the composition of foreign exchange reserve, bulk of it is invested in US Treasury bills. So if US T-bills are offering a higher interest rate, and they were offering in FY24 because of the tight monetary policy, US T-bills were offering 4% or even more. So that was one reason that led to higher foreign income for RBI. And the second part is that RBI did a lot of intervention in the foreign exchange market in terms of selling dollars to prevent the slide of rupee. We've talked about how exchange rate was kept more or less stable because of RBI's intervention both ways, appreciation as well as depreciation. So when RBI is selling dollars, at that point in time, if the purchase price is lower and the sale price is higher because rupee has weakened, dollar has risen, when you are selling dollars, you are getting more. So that was those were the two reasons, higher foreign income and lower expenditure that led to higher dividend. Now we need to see what is going to be the trajectory of the US Treasury bills this year. If the US Federal Reserve starts cutting rates, which as of now is expected that there could be at least 3 rounds of 25 basis points cut, then we will see a decline in the UST bills, and consequently that will have an impact on the RBI's foreign income. So that could lead to a reduction in dividend. So that is one thing, and also the pace of intervention. So it's premature to talk about the how income and expenditure will pan out over the course of the year, but we need to understand the factors that shaped the hefty dividend last year, and so these factors we need to look into this year also to see whether dividend will rise or fall.
Right. So there you go. There are several factors that have come together to make stock markets very volatile. One is the data that came out of the US, especially about its employment or unemployment situation, triggering fears that a recession might be happening there. The second is the Bank of Japan raising interest rates, which impacted this thing called the carry trade, which impacts a lot of the global markets. And the third is, of course, what's happening in the Middle East. The escalation of tensions over there is affecting oil prices, other commodity prices. And so right now everybody is a little jittery, and so the stock markets are also they're volatile. India is less volatile, but it's still volatile. If you look at the numbers, the markets have been going up and down. And so especially here where there is some concern that the market is a little overvalued, analysts are advising that be a little safe with your investments. But we of course are not going to give investment advice. That's not what we do here. But of course, always do your research before investing. That's all we can tell you. But on that note, thank you so much for watching.